Hey guys, it's Clint Coons here, and in this video, I'm going to teach you how to not screw up your next lease option agreement that you're using to sell your piece of real estate. Okay, let's get started. All right, so lease options, and really where I'm going at with this video is I want to talk about the tax consequences of entering into a lease option agreement and where you could get yourself into some tax issues by not setting them up the right way. And the reason I thought about bringing this up is that I've had a number of clients contact me recently because if you look at the market, interest rates have gone up, so it's harder for people to qualify now for mortgages. So what are they looking to do? Well, they can't come in and buy the property today. Maybe mortgage rates will go down in the future and they can qualify for that loan. So they're looking for a way to get into a property and have home ownership and not making an outright sale where they're buying it from you initially. So what you're going to do is you're going to enter into a lease option agreement with them where they're going to show a track record. They're going to be paying you for a set period of time, and they're going to give you a little extra money to have the ability to buy that property from you at a set point in the future. That's called the option agreement. So a simple scenario would be, hey, I'm going to lease you this piece of property. I'm going to charge you $1,000 a month. We agree that within 2 years, you can buy the property for $400,000 or its current fair market value, the greater thereof. I just gave you a hint there. When you put together your option agreements, you want to use that language. We had a situation where a client, their tenant, devalued the property through certain actions that they took on the property itself and made the property worth about a third of what it would have been worth had they not done this. And they were able to close on the property at that massively reduced price. So you want to put in their fair market value. You also want to have in there a do not commit waste clause. I mean, I should cut a video just on that alone. But anyways, so it's 2 years out, and then they're going to pay you a set sum of money to be able to buy that property for $400,000. Maybe that's going to be, you charge them $15,000 to lock that in, 400 or the current fair market value, the greater thereof. That's how a lease option works. Now, the elements to that, right? When you enter into a lease option, you have the purchase price. We'll just call that. That's $400K. Okay. You have the option money. In my example, it's $15,000. And then you have the rent. Okay, because there's two parts to this. There's a purchase in the future, and there's the current lease that's going on. So the rent is $12K a year. And the reason why I want to go through this before I talk about the tax issues that can come up with your lease options is so that you have a clear understanding of how options work from a tax standpoint. So when I enter into this agreement, because I haven't sold it yet on a lease option, I know I'm going to be making $12K a year, $1,000 a month from the individual, plus they're giving me $15K up front to lock in the property at $400K 2 years from now, $400K or fair market value, right? Greater thereof. Now, when I enter into this agreement and they write me a check for $15,000, all right, this money here is tax deferred. Okay, we don't have to report this income yet. This income gets deferred until the 2-year point or until until this person screws up and they violate the agreement and you kick them out of the property. So until something happens where they're no longer eligible or they close on it, you don't have to pay tax on that money. That's tax-free in your hands. Or tax deferred, that is. Now the rent, okay, this is income to you. Okay, so when you rent out your property, this is income. Now, of course, you can use depreciation to offset your income because you're still the owner of the property right now. When you've entered into this agreement with this party to have the ability to buy that property from you 2 years out. So generally speaking, this is the way it works on the front end. And then when you sell, let's say they exercise it and 400 is the purchase price, at that point in time, then when you sell, this is going to be long-term capital gains. So it'll be long-term capital gains, most likely 20% in your hands on the gain, not the full 400. So if I bought that property, my basis in it is 200, then the capital gains, long-term capital gains would be based on 215K is what it's going to be. Where did that 15 come from? Well, that's when you pay taxes on that option money again. You're going to pay taxes on it because it gets added into the sale price. So it's $215,000 at 20% if they exercise and they buy it from you. But that's 2 years out. Okay, so where does the problem come in? And there can be a couple of areas where you can screw this up. and it's going to create immediate tax consequences for you. And it comes into how you structure your deals. Because when I've seen investors do this before, they want to give assurances to the tenant that, hey, this is going to be your property. I'm going to entice you to come in. I want you to buy the property from you. So I'm going to build it in to make it, it's not a sale. We'll treat it as an option, but it really is a sale. Now, those are the problems you have. In court cases, they always look at that. What is the intent of the parties? And you can say your intent was to treat it as a straight up lease with an option to buy, and that it's not an installment sale, but the IRS can look at it and say, no, you really entered into an installment sale. And if you don't know what that is, that means that you've sold it today and you're getting paid out over time with a balloon payment in 2 years. If that's the case, then you have immediate income recognition on those payments you're receiving. And depending on what you are, if you're a dealer in real estate, if you flip property, you may be in a situation where that entire amount of that purchase price is taxable in year one, even though you didn't receive it. So you got to be careful. So let me just show you some examples of where people can screw this up. And if they get audited, the IRS will come in and put the finger on them. So let's assume that we have a property, going back to my example, $400,000. All right, that's what that purchase price is going to be. And we tell the person that's coming here, want to enter in this lease option with us, we want $10,000 down for option. Okay, that's the money you got to give us the option agreement. And we are going to charge you for this property $5,000 a month, $5K a month. All right, so, excuse me, this is the fair market value of the property right here. It's $400K. So I'm going to charge you $5,000 a month with $10,000 down. But in year two, when we sell the property, so when I sell you the property, the purchase price for you is going to be $270K. So 2 years from now, when you exercise your option, the purchase price will be $270. Now, remember, the fair market value is $400, but I'm going to agree to sell it to you in 2 years for $270. So how did we arrive at that number? Well, what we did is when we approached this individual who wants to get into this property, we said, listen, pay us $5,000 a month. That's $60,000 a year. So you're going to do this for 2 years. That's $60K. That's $120,000. Now we're going to add in the option money. So that's going to bring this up to $130,000. I'm then going to take the $400,000, which we agreed the property's worth. I'm going to deduct the $130,000 that I've collected from you over the past 2 years, and that leaves a total grand owing on this deal of $270,000. What did you just do? You entered into a sale, right? You're trying to put a different take on it, call it something else, but if it looks like a duck, talks like a duck, walks like a duck, it is a duck, and that's what we have here. So in this scenario, the IRS, if they audited you, they would say, hey, you sold this property in year one. And so I'd be careful, you don't want to structure deals like this where you're reducing the fair market value. If they see that, hey, there's this huge reduction, they know you're crediting it. The other giveaway here too is the rent. Look at $5K a month. Maybe in that area, $400,000 house, it's going for $1,800 a month. So we know right away, hey, this is way above monthly market rate. So this is definitely a sale, and it's not a true lease option agreement. We're releasing the property to someone, and at the end of the lease, if they want to buy, they can buy. No, we intended to sell it to them today. Now, people can spin this another way as well. They can agree to keep that purchase price at $400,000. So I've seen them set up this way before. They'll say, oh, no, we're going to sell it to you for $400,000. Right? But what we agree to do, if you exercise that option in year two, we're going to take what you paid us over the course of 2 years. As long as you're current on all your payments and you make these payments, we will give you a credit for $130,000. So at closing, you're only going to pay us $270 on the purchase of that property. So again, if you look in the lease option agreement, if you get audited and the IRS looks at it and they say, all right, let me see what your option terms were. If it says there's going to be a credit for everything that you were paid, that is a sale. Now, another issue that I've seen come up before, people, again, investors are always trying to get creative. And a lot of times you'll see this if you're dealing with property, if you're going to enter into a lease option for commercial property or maybe undeveloped land, you set it up and you say, all right, I'm going to sell you this property for $500,000, right? Now, when we enter into this agreement, I'm going to charge you $2,000 a month rent, okay? So that's your rent on a monthly basis, and you're going to pay me a $50,000 option fee for this. But here's the other thing. You're going to invest $400,000 into this property to develop it. So now you've got somebody coming into the deal and they want to enter into what's called a lease option with you, but they're going to make a massive investment into this property. And then in 2 years out, they get to buy it for $500,000. Now, you just look at this deal and you know something's off here, right? Because if I had this tenant invest $400,000, okay, almost the entire value of the property into this deal, what is the value of that property now? Easily, let's say it's $1 million, right? Easily it'd be $1 million. You put $400,000 in, you're going to get equity in there, so it's worth $1 million. But in 2 years, they get to buy it for $500,000. This is a scenario where the IRS might look at it and say, all right, the intent here was to sell them the property, but structure it as a lease so this business owner that's in this deal right away doesn't have to take ownership, can do all their investing to get this up. And of course, they get to write off the cost of the lease and depreciate it. So there's a scenario where they would say this is definitely a sale and it wasn't a true lease option. So if you ever think you can structure it where you just give them the ability to make this huge investment, that can be a problem as well for you. So what actually would work if you wanted to do a lease option with someone, you wanted to sell your house on a lease option? Where it's going to work out the best for you is when you use reasonable terms, all right? So you set it up and you say, let's assume my example, again, it's $400,000 is that purchase price. We charge $20,000 for the option, all right? And then on a monthly basis, maybe the market rate is $1,800 a month, but I'm going to charge you $2,500, okay? I'm going to charge you $2,500 a month, and I'm going to credit you $700 towards your purchase price if you choose to go through with this. Now, if you look at this, it's not a lot relative to the overall terms. We've increased it by $700 and we're giving them a credit. So it's still in a scenario there where you're in this area where it's not an outright sale. They're not fully invested to the point where, you know, oh my gosh, they've got, what's that, 700 times 12, 80, $17,000 they would give up plus the option money if they walk away. It's a lot different than the scenario where I gave you before, where they give up $120,000 if they walk away, or $400,000 improvements. Here it's a lot less. So the IRS then tend to respect this type of arrangement because it's more in line with what someone may be willing to pay for an option to get into a piece of property, to see if they can't build up a little bit of cash. And maybe you structure it, depending on your scenario, where, hey, this is going to be held in reserve. So if you go back, we'll maybe even credit back 50% of this to you or something like that if you don't go through with it. So you can get creative here as far as trying to entice people to come into these lease options. Because definitely you want to help them out and you want to sell your property, you want to move it, you want to collect rent on the front side. But it's important that you keep it in that context, because when you enter into lease options, remember how those numbers work out as far as taxes. You don't want the IRS to come in and say, hey, this is a sale, because that $20,000, that money to you is free money right now, right? You can take that and you can reinvest it. You don't have to pay taxes on it until that 2-year mark. So the tax side of lease options, it can be a little confusing. But it really comes down to, don't be too creative here. Make it look like a sale, because if you do get audited, it's going to get compressed down on you and you're going to have to pay taxes and penalties for not accurately reporting it. Hey guys, I hope you learned something there about lease options. Be sure to check out the show notes for some important links about other content that I have on my channel. And you can then, if you like, sign up for my upcoming tax and asset protection event. Take care.